Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is August 29, 2022, and I'm going to go over your three threes for the week. I'm going to go over our top three market movers and economic data for the week. I'm also going to go over our favorite three asset classes. And after a volatile week, we're going to go over how we're positioned on the equities and on the bonds. So let's jump on in.
Okay, let's go over the top three market movers for August 29th. We're going to go over some economic data, some from last week and some from this week. We're also going to go over number two, which is our graph of the week, which is our U.S. new home supply. And number three, we're going to go over the Fed pivot to our recent non-pivot. So let's talk about the economic data. Last week, we had our second revision of GDP. It came in a little bit lower than estimates at negative 0.6 versus negative 0.9. And Friday, we also had the PCE price index, which went up 6.3, and the core PCE went up 4.6. I'm going to go over that here in just a second. But we all know that the, quote, textbook version of a recession is two negative GDPs, which we've had in the first and second quarter. But let's talk about the third quarter. Right now, the Atlanta Fed, which has its GDP now, their estimate is third quarter at 1.6. However, the range is really wide, and it's at negative 0.3 to 2.7. And a lot of that has to do with there's still a lot of data over the next 2 months that is going to move this GDP number, okay? And which is why the Fed is going to remain data dependent, okay? So based on what we see over the next couple months will drastically affect this GDP number. Okay, now I know I went over the PCE and the core PCE last week, but there's a couple good points here I want to point out. The core PCE, which is excluding food and energy, moved down to 4.6 off its peak in July, but it did increase month over month by 0.1. However, the peak was actually in February of 22 this year, and then the Fed raised interest rates by 25 basis points in March. Now, unlike the CPI actually peaked in June. Okay, so you can almost say the PCI is a lagging indicator to the core PCE. So this is why it's the Fed's favorite gauge and probably something that we want to go ahead and really kind of keep our eye on moving forward instead of that CPI that the social media and the media tend to take a look at. All right, so let's talk about this week. We have 11 separate Fed speeches, and they're basically going to come out, and if the market is selling off, they're going to come in and soften the blow and probably have a dovish type of a tone. If the market bounces and starts to go higher, they're going to probably come out and say, you're not listening to Fed Chairman Powell. He is hawkish right now. So it's going to be interesting to see what the tone of these speeches are for this week. On Thursday, we have the ISM manufacturing and jobless claims. And then Friday, we got a big number coming out, which is the jobs, the unemployment report for August. If you remember back in July, we had a huge number of 528,000 jobs, which is twice what they were expected. So now they're estimating 270. So we'll see what this number is, and we'll see what the revision is, and that could be a market mover for the week. All right, let's go over our chart of the week, which is our U.S. new homes and the months of supply and inventory. Right now, it is at 10.9. So it's above this 10, which is a line that it's the highest since really January of 2009. But when it gets above 10, every time over the past 45 years, we were coming out of a recession, okay? Except, quote, this time based on the White House. Well, we are in a recession. It's shallow, but the White House doesn't want to admit it. But if we're not in a recession, then this is the first time ever that we have not been in one and we've been above here. So we are, okay? And this is also to that point. This is a good correlation between existing homes and new homes, okay? And as you can see, it's been a pretty tight correlation until a couple years ago, came back together after COVID, and then the new home supply shot up. Okay, yes, I know that has a lot to do with interest rates, right? So that inventory, basically, there's a huge supply and no demand, where the existing homes, they've remained pretty tight. That means everyone's just kind of bunkered down, and as long as everything stays good, they're going to go ahead and continue to stay in their homes. Okay, so we got to hope is that doesn't, this recession, jobs don't get bad, foreclosures get bad, and that number starts to go up like it did in the 2007, 2008, 9 period, or interest rates start coming back down and all of a sudden the supply starts to get depleted. We shall see which way we go. We'll find out here probably shortly. Okay, now, however, this is the problem that we're starting to see. The excess savings that we had due to COVID and all that free money that they were printing is now gone. So that we don't have the consumers not in trouble, but they just don't have the money because inflation is hitting them square on the chin. So even though the gas prices have started to come down, well, the electricity and the utilities have started to go back up, almost offsetting. So they're still depleting their excess savings. So we've got to be careful here moving forward. All right, but let's go over the Fed pivot, non-pivot. Okay, now everyone was anticipating that Powell was going to pivot and start stop raising interest rates and bringing them back down. Well, on Friday, he said, I'm not going to do that. He basically said, I'm going to be Volcker-esque and I'm going to raise interest rates until the job is done. Okay, so he slammed his fist down and said, we are going to raise interest rates, and the market sold off 1,000 points because of it. Now, and the reason is because Powell, okay, he doesn't need the money, but he wants to leave a legacy. He wants to make sure that he goes down in the record books of taming the 2022 inflationary period. So he wants to be that guy. He does not want to be fired like the guy before Volcker, Burns. And so he is going to do whatever it takes to fight this off. Now, to keep in mind, when he was Fed chair from 79 to 87, we still went through some pain while he was taming the inflation during that period. Inflation peaked at 14.6. We've gone up as high as 9.1. The Fed funds rate hit 19.1. We're at 2.5. Okay, so we got a long ways to go before we get to 19.1. But during that period, we went through 2 recessions, one in 1980 and then another one from 81 to 82, where unemployment hit 10.8. We're at 3.5 today. And the S&P fell as much as 33. Yes, we've had a 20% correction, but the market sold off and it continued to sell off and it went back up and then it sold off again through that 1975 to 80 or 1970 to 82 period here. So we are not done by any means out of this. So what we thought was coming in as a soft landing is now basically the Powell has said it's going to be a hard landing. And to go quote Mr. T, he said, what is your prediction? He said, pain. Well, Powell also said, anticipate some pain. Okay, so we've got to keep that in mind. So, and that's why the market, again, sold off 1,000 points on Friday. Okay, so again, what is our top 3 asset classes? There has no change from last week on a long-term basis. It's still T-bills, US dollar, and utilities. Our systems are telling us it is still defense. It is the primary driver of this market, and it did protect us last week while the market sold off. So we've got to keep that in mind, even though we're going to have some bear market rallies here. Okay, let's go over how we're positioned on the bonds. We've gone over this chart each week. Well, and as you remember, it dropped down 13%, and then it hit our trigger. Our system said, hey, it's time to start nibbling in some bonds. We did, and then bonds have subsequently sold off, and they're right where we started buying them. So we've started to take off some bonds. We've kept a little bit on, but we shall see what happens here. But when our system tells us to get back into bonds, we'll start adding bonds again, or we're already on defense, so we'll be protected if bonds continue to sell off. The same goes for equities. Okay, our system said, hey, time to start nibbling at some equities on the short-term basis. So we did, had a nice run, went through these support and resistant levels. Well, it sold off on Friday. You can see the candle here. Now we're only up 2.5 when we were up as high as almost 7-8%. So now this resistance, which became support, is now resistance again. So if this comes up here and rejects this, and it does become resistance, then we will possibly see a retest of those June lows. So we'll see what happens. But again, we've started to trim back and pull back some of those equities and bonds that we were nibbling at, and we shall see what our system tells us to do. But that's our short-term look as far as the equity and the bond market. That's it. Thank you for joining us. Labor Day is next Monday, so our next update will be Tuesday, September 6th. But as always, continue to subscribe, like, and comment on our videos, and watch some of our other videos. And that's it for this week. So have a wonderful week trading.